everyone. Let's discuss Ind AS 7 statement of cash flows today. First, let's start. Objective of Ind AS 7 is nothing but to assess the ability of the entity to generate the cash and cash equivalents and the needs of the entity to utilize those cash flows and the timing and certainty of the generation of such cash flow. First is to ability to generate and needs to utilize, and then timing and certainty of generation of cash flow. What are the things to be assessed? Assessed the ability to generate the cash and cash equivalents, the needs to utilize those cash flows, and the timing and certainty of generation of cash flows. And it also require the provision of information about the historical changes in cash and cash equivalents. That is like we get the what is the net change in the cash and cash equivalents, like in the cash flow statement, to provide that information. Now, presentation of a statement of cash flows. Report the cash flows as both inflows and outflows during a period as either operating activities, investing activities, finance, and cash equivalent. What do we mean by the term operating activities? These are the principal revenue producing activities of the entity which are other than investing and financing activity. For example, sale of goods or purchase of goods or some current liability, current asset generation. Those will be known as principal revenue producing activities. Okay. Now for those, we have two methods here. One is direct method, another one is indirect methods. One is direct method, another one is indirect method. Direct method is like we start with gross cash receipts and gross cash payments are disclosed, and likewise we put all the income, then less all the expenses, then we arrive at the operating cash flow. This is what is the method for approach followed under direct method. Under indirect method, we start with profit or loss for the year, just taken from the statement of profit or loss. Okay, whereby the profit or loss adjusted for non-cash transaction, for example, unrealized gain or bad debts, depreciation, amortization, any deferrals or accruals of past or future operating cash receipts or payments, items income or expense associated with investing or financing activity. For example, interest or dividend, or interest paid or interest received, dividend paid or dividend received, something. Those will be adjusted for. So on the indirect method, we will start by profit or loss from the statement of profit or loss and other comprehensive income, and then adjust it for non-cash transaction like depreciation, amortization, and any deferrals or accruals of past or future operating cash receipts or payment, like for example bad debts or bad recovered or something like that, and then items of income or expense associated with the investing or financing cash flows. Now, let's understand what is the investing and activity. Investing activity is acquisition. Acquisition means purchase, and disposal means sale of long-term assets and other investment not included in cash and cash equivalents, which means sale of machinery or purchase of land, or for example, sale of an equity invested in somewhere, something like that. Okay, which is not included in the cash and cash equivalents. Or an entity shall report separately major class of gross receipts and gross cash payments arising from the investing and financing activity. It should report each head separately. Like for example, all the equity related investments can be grouped together and mentioned as equity securities. Okay, maybe listed, unlisted, then some bifurcations could be given from that. Okay, now financing activity. Financing activities are activities that result in changes in the size and composition of the contributed equity and borrowings of the entity. Contributed equity for now we understand as equity share capital plus reserves and surplus. Okay, what is there in the change in the size and composition of the contributed equity and borrowings of the entity. Borrowing is very simple. Long-term borrowings could be there, or short-term borrowings could be there. Likewise, now the term cash and cash equivalents would mean. Cash and cash equivalents. Cash means it comprises of cash in hand and demand deposits. Cash in hand and demand deposit. What does cash equivalents mean? Those are short-term, highly liquid investments, marketable securities. Okay, within some particular months it has to be, within 3 months it has to be sold. That is, it can be made into readily available cash. Convertible to known amount of cash, are subject to insignificant risk of changes in value. This is the keyword. Insignificant risk of changes in value, are not for investment purpose. If it is for investment purpose, then it has to be classified under investing activity. and has a maturity of 3 months or less from the date of acquisition. This is the key point here again. For example, I have an FD which is for 1 year, okay, but it is maturing on 30th June 2023. Okay, I am going to prepare financials for 31st March 2023. Whether this fixed deposit will be classified as cash and cash equivalents because it's maturing within 3 months. Answer is no. Answer is no, because it from the date of acquisition till the date of maturity, the period is greater than 3 months. So any asset will be classified as a cash and cash only when from the date of acquisition till the date of maturity, the period should be less than or equal to 3 months. Less than or equal to 3 months. For example, if I have a FD which is maturing in 60 days, then such FD will be known as cash equivalent. Okay. Exception. Equity investments are excluded from cash equivalents. Even though the equity investments will be, I am with a view to sell the equity investments within the next 3 months. Even then, this will not be classified at any instance as cash and cash equivalents. Okay, one like FD, demand deposit, something like that. It has cash and cash equivalent. I hope it is very clear, right? Now, entities are encouraged to follow direct method. Okay, the direct method provides information which may be useful in estimating future cash flow, which is not available in the indirect method. I can prepare the future projections of cash flows based on direct method. The same cannot be done with the help of indirect method. That's why the uh, entities are encouraged to follow direct method. However, but in the industry standards, there could be like similar companies that follow indirect method. So, for the presentation purpose, I would be required presentation and comparison purpose. I would be required to prepare the cash flow statement on a indirect method. Okay, now let's move on to the next point. Cash flows arising from operating activities. Let's understand what are the key indicators. Okay, repayment of loans. Key indicators of the extent to which the operations of the entity have generated the cash flows or to repay the loans, maintain the operating capability of the entity, pay dividends, and make new investments. Source of financing. Okay, it is primarily derived from the principal revenue producing activity. Principal revenue producing activities. What are those? Those could be cash receipts from sale of goods or rendering of services, royalties, fees or commissions, payments to supply employees, cash receipts or payments to the insurance entities, cash payments or refunds of income taxes, unless it's specified, will be classified under the operating activities unless it is specifically identified with some item which is there in investing or financing activity. For example, there could be a payment of dividend distribution taxes which specifically with respect to dividend, which is a financing activity. That's why those amount would be included or this will be shown under financing activity. Or if I'm able to compute the exact amount of capital gain which is arising on the sale of a particular plant and machinery, then to that extent the income tax will be shown under the investing activity, or else I will show the entire amount as an operating activity. Payment for contracts held for dealing trading purposes, then purchase of sale or dealing of trading securities. If it is for trading securities, then it will be operating activity. Then financial institutions, since revenue producing is the major activity. In the case of financial institutions, the main activity, their main revenue generating activity is to give loans and take deposits, right? So for them, giving loans and advances will be forming part of the operating activity rather than the financing and investing activity. Also, if I am into share trading business, share trading will be forming part of my operating activity and not the investing activity. Now, generally result from the transactions and other events that enter into the determination for the purpose of profit or loss. Like mostly these events will be related to determining the profit and loss. Those items that give the profit and loss account statement will be forming part of the operating activity, to be simply understood. Okay. Now, let's move on to the activity. It represents a cash to which the expenditures have been made for the resources intended to generate the future cash flows. Okay, I am creating some asset to generate future cash flow. Those amounts which have been incurred for creating an asset to generate future cash flows will be known as investing activity. Okay, example, I could have made payment to acquire some property, plant, and equipment. Okay, then sale of property, plant, and equipment or another intangible. Cash payments to acquire equity or debt instruments to have a long-term interest, and then cash receipts from sale of equity and other debt instruments. Okay, then cash advances or loans made to other parties, other than the loans which are given by the financial institution. For financial institution, it is forming part of operating activity. For others, loans and advances will form part of investing activity. Cash receipts from the repayment of loans and advances. Cash payment for future contracts, forward contracts, and so on. Then derivative contracts, something like that. Okay, which is held for trading. Okay, see, whenever it is held for investment purpose, it will be there in investing activity. Whenever dealing trading purpose or payments classified as financing activities. So it is for trading purposes, then it will be like operating activity. For if it is operating it as a financing purposes, then it will be like financing activity. Cash receipts for repayment, that will be there. Payments and repayments. Then what is the other point here? Only expenses that is recognized and result of an asset in the balance sheet are eligible for classification of as investing activities. Only those expenditure which are eligible to be capitalized, that is eligible as an asset, that only will be classified as an investing activity. Nothing else will be forming part of investing activity. Now, there's a note to be checked here. When a contract's account is in hedge of identified position of cash flows as classified in the same manner as the cash flow position being hedged. So when a contract is accounted for as a hedge of an identifiable position, the cash flows of the contract are also classified in the same manner as the cash flows of the position being hedged. If it is classified as an investing activity, this hedge will also be classified as an investing activity. Okay. Financing activity useful in predicting the claims of future cash flows by the providers of capital. So when how much they are entitled to receive back is known as financing activity. Issue of equity instruments, payment to redeem the equity instruments, proceeds from issuing debentures, loans, bonds, notes, mortgages, and short-term, long-term borrowings, repayments of the amounts borrowed, cash payments by lessee for reduction of the outstanding liability relating to the future finance lease. So operating lease will be forming part of the operating activity when it is a finance lease. Okay, any cash payment which is made by the lessee for the reduction of an outstanding liability in relation to a finance lease will be classified as an activity under financing activities. Okay, will be classified as a cash flow under financing activities. Okay, clear. Now, reporting of cash flow on net. Okay, reporting of cash flow on a net basis. Let's first check for financial institutions. Okay, cash flow arising from each of the following activities of a financial institution may be reported on a net basis. Okay, what are the things? Cash receipts and payments for acceptance and repayment of deposits with a fixed maturity date. Receipts and payments with respect to a fixed maturity date. The placement of deposits and withdrawal of the deposits from other financial institutions. Cash advances and loans made to the customers and repayment of those loans and advances. With respect to the loans and advances, deposits either with the customer or with the other financial institution, those can be reported on a net basis. Those can be reported on a net basis. Those can be reported on a net basis. This is only for financial institution. Okay. Now, for other than financial institution, cash flows arising from the operating, investing, or financing activities can be reported on a net basis. When cash receipts and payments on behalf of the customer, when the cash flows reflect the activities of the customer rather than those of the entity. When it is for belonging to activities of the customer and not me, okay, not the entity, then it can be reported on a net basis. So for example, okay, cash receipts and payments referred to in paragraph 22A as acceptance of demand deposits of a bank, funds held for customer by an investing entity, rents collected on behalf and paid on behalf of the owners of the property. I'm just collecting, I'm a trustee. And both receipts and payment can be net off. Okay, this zero, right? So that is can be net off. Cash receipts and payment for items which the turnover is quick, this amount of large and maturities are short. Principal amount relating to credit sale of investments. Other than other short-term borrowing, the maturity is 3 months or less. Okay, these are things have to be. It can be a theory question. Okay, right. Principal amounts relating to credit card customer, the purchase and sale of investments, other than the short-term borrowings, for example, where the maturity is for less than 3 months. Okay, we report on a net basis. All of the things have to be reported on a gross basis. Now, foreign currency cash flows arising from transactions in foreign currency recorded in the entity's functional currency. Functional currency means the currency which fulfills a certain criteria, right? That will be also be discussed somewhere. Okay. functional currency. Foreign currency amount into exchange rate between the functional currency, the foreign currency at the date of the cash flow, the date of the cash flow, the date flow. That will be the amount, okay, then of a foreign subsidiary. If it is money for foreign currency transaction, then this will be the method, okay. Foreign subsidiary, then cash flows from a foreign subsidiary into exchange rate between the functional foreign currency at the rate of cash flow. Similarly, here it is foreign currency amount for the particular transaction. Here is the entire cash flow of the foreign subsidiary. Now, cash flow denominated in foreign currency are put in one. A weighted average exchange rate for the period may be used for recording the currency transaction or translations of the foreign currency for a foreign subsidiary. See, here it is a particular date transaction. So I am able to get the particular exchange rate, but will have a cash flows from the subsidiary on multiple days. So it is very difficult to keep on applying the exchange rate on each day. That's why I am permitted to use the weighted average exchange rate for the particular period. Ind AS 21 does not permit, this is very important. Ind AS 21 does not permit use of exchange rate at the end of the reporting period when translating the cash flows of the foreign subsidiary. Here, since I am eligible to use, see, let's make it here. I am eligible, let me make this word, permitted to use the weighted average exchange rate for a period instead of exchange rate on the date of cash flow. However, I am not permitted to use the closing rate, that is exchange rate at the end of reporting period. I'm not eligible for conversion of subsidiaries cash flow. I hope this is very clear. Okay, very important. Okay, just apply blindly and do the conversion at the closing rate, but that should not be done. Okay, that's an important point. Okay. Unrealized, okay, now, yeah. Unrealized gains or losses arising from the changes in unrealized gains or losses are not cash flows. Unrealized gains and losses are not cash flows. Unrealized, what happens is that I have only one account in my entire financial status. Capital is there, and other I have invested the entire thing in foreign currency cash flow of $5,000. Okay. In the initial opening date, it was 75 rupees per dollar. Okay. And the closing date is 80 rupees per dollar. The 5 rupees is unrealized. I am not realized it, right? So that is not a cash flow. That is not a cash flow. Excuse me. The effect of the exchange rate changes on cash and cash flow equivalents held or held due in a foreign currency is reported in the statement of cash flow in order to reconcile the cash and cash equivalents at the beginning and the end of the period. By this, what happens is that profit or loss 0, unrealized will be some 5,005 rupees, 25,000, correct? Then it will be, I have to net it off, and this will make there is no changes in the cash and cash equivalents. Then I have to show that there is a cash and reconciliation stating that there is unrealized gain on such foreign currency deposit which is being held. That's why it is matching. I have to show that reconciliation. That's what mentioned here. Okay. Now, cash flows arising from taxes on income shall be separately disclosed when it's practicable to identify the cash flows associated with investing or financial activity. I've already mentioned, like, if it's one particular difference, that I have to mention it separately. Impracticable to identify, then it will be classified as an operating activities. Okay. Now, and tax flows are allocated over more than one class of activity. The total amount of tax is to be disclosed. Okay. Somewhere in the cash flow statement, at the end of the cash flow statement, I have to disclose the total amount of taxes paid. Okay. I have to add all the taxes and show that here. Investment subsidiary, associate, and joint venture. When accounted by use of equity method, investor restricts reporting a statement of cash flows to the cash flows between the itself and the invest. That's different advance will be only be disclosed when it is using the equity method or cost method. Okay. When it is an associate or a joint venture using the equity method, then the cash flows in respect of the investment and associate and joint venture has to be shown. Distribution of payment and receipts to be shown, and then these two are to be shown. Okay. Simply speaking, if it is equity or cost method, only it's there. Okay, then I have to show only the cash flows between the investee and the itself. Okay, there is a difference and advances. Okay, when it is a joint venture or an associate, then I have to show the cash flows in respect of the investments in associate and joint venture, and also its distribution. Now, the interest and dividend. Interest and dividend. Cash flows from interest and dividend paying shall be separately disclosed. Should be separately disclosed. Should not be merged with some other thing. Should be separately disclosed. In the case of institution, interest paid and interest received will be known as operating activity. Dividend paid and dividend paid will be known as financing activity because they add the cost of borrowing of obtaining the financial resource, that is the equity. Now, in the case of other entities, also dividend paid will be known as financing activity. Interest paid will also be shown as financing activity. Interest and dividend received will be known as investing activity because there are return on investment. Okay, it's very clear, right? Changes in ownership, interest in subsidiary and other businesses. Cash flow arising from obtaining control of the subsidiary and other businesses, losing control. Okay, it is obtaining control means I'm cash outflow, losing control means I'm getting cash inflow. Okay, shall be classified as investing activity. Cash flow arising from changes in ownership or interest in that do not result in loss of control shall be classified as a cash flow from unless the subsidiary is held as an investing entity. Which means if I am putting that investment as an investing activity, then if there is any changes in ownership which does not result in loss of control, then such can be classified as an financing activity. Okay, shall be presented separately. The cash flow effect of losing the control are not deducted from those of obtaining control. The total consideration of paid or received, the portion of the consideration consisting of cash and cash equivalents, the amount of cash and cash equivalents and subsidiary and other business over which the entity has obtained or lost its control, and the amount for the which the control is obtained or lost summarized by each category. You need not apply an investment in subsidiary measured at fair value through profit or loss account. These have to be done. Okay, like it should be presented separately. That is, what are the cash flows? Because it could either be a consideration received or a portion of cash. That could be a portion of cash and cash. Those should be disclosed separately. And how much amount, as to how much percentage, that should be disclosed. But these are to be showed as separately. Okay, but this presentation in a separate manner need not be done if it is an investment subsidiary measured at fair value through profit or loss account. Shall disclose in the aggregate. They have to disclose in an aggregate manner. Okay, that is these things. Okay, aggregate manner. Okay, either it is obtaining control or losing control. I have to check. First, I will classify it as an investing activity, and if the change in ownership does not result in loss of control, then it will be amount will be shown as a financing activity, and that's all. Okay, no other adjustment is there. Now, second thing is that I should present it separately. That is, losing the control should not be merged with the having the control. Okay, so those should not be netted off. So I have to show it separately. And third thing is that I should disclose it as aggregate. I have to show the total amount of consideration received and what is the amount received in cash. What is the percentage of those which is control lost or control obtained, and then whether I obtained any other assets. Okay, and these things need not be disclosed in aggregate if this subsidiary measured at fair value through profit and loss account. Now, closures. Investing and financing transactions that not require the use of cash and cash equivalents shall be excluded from the statement of cash flows disclosed elsewhere in the financial statements. Component of cash and cash equivalents disclose the component of cash and prepare the amount reconciliation, and then disclose the policy in which the entity adopts in determining the cash and cash equivalents. The disclosure disclosed together with the commentary by the management, the amount of significant cash and cash equivalents balance held are not available for use by the group. Okay, maybe this could be have been pledged somewhere or something like that. Okay, the note, the requirement shall equally applicable to entities in case of separate financial statement also. Either it is consolidated financial statement or separate or standalone financial statement. For all the financial statement, these will be applicable. Now, we have two important case studies in education material in the examination. So let's discuss those. One is with respect to foreign currency, the other one is with respect to subsidiary. Okay, give me 5-10 minutes, we'll complete this also. Entity A of physical currency is Indian rupee, is a balance of cash and 2 lakh, but has no trade receivable. So as on the opening date, there is no trade receivable or trade payable, only opening cash is there. Okay. During the year, the entity has entered in the purchase of goods, the balance is still unpaid, and it has a gain, exchange gain on retranslation. Okay, then it has sold goods, amount was settled, and exchange gain was 3 lakhs, which has been recorded in statement of profit and loss account. Okay, which means here it is still unpaid, so it is unrealized gain or loss. It is unrealized gain or loss. It is unrealized gain or loss. Okay, But here it is realized gain or loss because I've realized, I've settled. So there is no balance. So it is realized gain or loss. Okay. And here it is also, it is borrowed so and so amount as a long-term arrangement paid. Okay. That's why it is again unrealized one. Then therefore it records 5 lakhs plus 3 lakhs plus 5 lakhs, total is 13 lakhs as a cumulative gain in the profit and loss account. In addition to this, it records a gross profit of 10 lakhs. So we have to check how these transactions have to be recorded. Okay. It's also given the method is indirect method. So we have to start with profit or loss. So profit or loss would be 10 lakhs. I have to add the exchange gain. So before taxation and exchange gain, so it is 23 lakhs. So before taxation is 23 lakhs. Adjustments for unrealized gains or loss have both unrealized that is with respect to trade payable. So it will give me operating cash flow before working capital changes as 13 lakhs. What is the change in working capital due to increase in trade receivables, trade payables? There is no increase in trade receivables because it has been settled. 0 in the opening, 0 in the closing. There is no increase between the balance sheet date. But in the case of trade payables, it's 0 in the opening and 50 lakhs in the closing. So 50 lakhs has changed. Okay. You will ask me like 45 is the closing balance. If you track this, 45 will be there. 50 lakhs minus 5 lakhs, 45 lakhs. Okay. Then this is the net cash flow from the operating activity. Then cash flow from the opening, that 50 lakhs have been borrowed during the year, that is given here because of the inflow. 15 is the that increase in the cash and cash equivalents, and the beginning of the period was 2 lakhs. So cash and cash equivalents at the end of the period was 1 lakh, 1 crore 15 lakhs. Taxation is ignored because it's not given, we have to ignore it. Okay, that note has to be given. The last case study for the day. Subsidiary acquired in the year. Entity A has acquired a subsidiary, entity B, during the year. Summarized information from the consolidated statement of profit or loss in the balance sheet is provided together with supplementary information to demonstrate how the statement of cash flows under the indirect method is derived. Okay, we have some profit and loss account and balance sheet. Okay, now here's the entity B. All of the shares 100% is being acquired for 74,000 in cash. And this is the value of the assets and liabilities. Okay. Now, I have a credit statement of cash flows. Okay. Let's first discuss what is there in the cash flow and then we will check how we arrive at that amount. Okay. Now, adjustment for profit before taxation 70,000 adjustment. First is the appreciation entries, decrease in trade receivables, trade payables. These are operating activities, right? Interest paid to be included in financing activity will remove from operating activities and charge to financing activities. So now, I'm sorry. Yeah. Now, net taxation, because taxation will be there. Net cash flow from the operating activities is this much. Okay. Now, cash paid to acquire the subsidy will be shown under investing activities. Then, interest paid and net cash flow from the financing activities. Now we have the cash flow cash equivalents at the end of the year. Now let's see how we arrive at this amount. Depreciation is taken directly from here. Okay, it is 30,000 here. That's what we are taking it here also. Okay, let's just minimize the font size. I hope it's not a big deal. Then decrease in inventory. Okay, I have an opening inventory in the balance sheet. Okay, generally in this balance sheet is assumed that it is assumed that it can be two ways. Okay, one is that I could show the change in inventory as the cost of materials consumed, like cost of goods sold, like that I'm showing the inventory. Okay, one could be that way. Other way of understanding is that this opening balance sheet does not include the figures of subsidiary, and that's why I am deducting it also. Okay, there are two ways of understanding. Okay, one is I am reporting change of inventory as cost of goods sold. Okay, other one would be like similar to the cost of goods sold formula. Okay, similar formula would be used. Okay, not the exact one, but similar formula would be used. Otherwise, in the previous year cash balances does not include subsidy. That's quite a good method, right? Because from the rate of control, because it's acquired during the year, only the closing balances will be there, right? So it's a good method. That's what has been assumed. Okay. So for inventories, it is 30,000, 35,000, I mean 35,000 opening balance, 30,000 is the closing balance. Okay. And the inventories of 4,000 have been acquired, which means closing balance would be, let's understand this way. Okay, closing balance is 30,000. Okay, we have to less opening balance 35,000 and which has been acquired. Subsidiaries acquired during the year 4,000. These to be less, right? So 39,000 minus 30,000, this will be 9,000. Okay, this is the first one. Hope it's clear, right? Similar method is followed for trade receivables and trade payables also. Okay, like 54,000 minus 8,000 minus 50,000, 4,000. Okay, then 68,000 minus 30,000 minus 60,000, 24,000. Okay, yep. Okay, so this interest paid to financing activities, it will be there directly in the interest cost. 4,000. Okay. Okay, let me check. Okay. Depreciation, inventories, trade receivables, trade payables, interest paid, there is nothing is there. Okay, but 4,000 should be there, right? Yeah. And then we have taxation. Okay. Taxation we arrive at here like the opening plus closing and the current year provision. That's why we arrive at 11,000 for plus 15,000 minus 12,000 is 14,000. And interest rate, this calculation error, there's a presentation error here. 23,000 is not there. It is 4,000. Then only then you will arrive at this cash flow. Okay. So this is what is correct. 4,000 is correct. What we discussed is correct. Okay. Now rest all is given. Cash paid is subsidiary. Why it is we have paid 74,000? Why it is 72,000? Because we already have 2,000 in cash in subsidiary. So we'll say that we are going to pay 74,000. We are going to receive 2,000. The net what we have paid is 72,000. Okay. So the cash and cash equivalents at the end of the year is 8,000. I hope it is very clear till now. Yeah. So with this, we have completed in day 7 in detailed manner. If you have any doubts, you can post in comments. And if you really like this video and feel this is useful, then please do like and subscribe and share with your friends for better reach. Thank you. Nice day.